As the stock market moves from a bear market to a bull market, investors must be brave, patient, and flexible when looking for the best stocks to buy in 2023. Many market strategists say you can only go from one market to another if you go through a recession first. Russ Kosterich, portfolio manager from the BlackRock Global Allocation Fund, says, given how fast and hard the Fed is tightening, it's very likely that the U.S. will go into a recession in 2023. We think it will be a mild recession because household balance sheets are strong and consumer spending is holding up. But what are the 5 best stocks to buy in 2023? In this video, we'll talk about 5 stocks that long-term investors who want to put their money to work might want to buy in 2023. Given that the stock market is uncertain and sometimes tumultuous, where should investors look for the best stocks to buy in 2023? Strategists on Wall Street often tell people to avoid the cheap allure of stocks that have been badly hurt and instead focus on high-quality shares. According to Kosterich, investors should stay away from volatile stocks and be careful with high-value and high-growth companies that don't make money. Instead, focus more on quality and consistent earnings and good profitability. According to Caroline Randall, a portfolio manager at the mutual fund company Capital Group, generous and growing dividends are a sign of high quality and are likely to make up a much bigger part of total returns than they have in the past. Considering this, here are the 5 best stocks to buy in 2023. The stocks explained in this video vary in size and industry and are not meant to make up a portfolio with a wide range of investments. But for one reason or another, all of them are a good position to make money when the bear market ends in 2023 and a bull market starts. Number 1, Amazon. Amazon is a major player in the cloud, digital advertising, and e-commerce, all of which are expected to grow in the long term. You may have even heard of this company. Each of these investors in this business are familiar with the wide economic moat that it has, as Warren Buffett is a big fan of, which may actually be even more important. Amazon's web service business is the market leader regarding cloud infrastructure services. Cloud services are usually one of the last things a business will cut when times are tough, so this business benefits from the fact that customers have to pay a lot to switch. Also, the size of Amazon's web services business gives it many cost advantages since only some companies can compete with Amazon's investment spending and first mover advantage. Regarding digital advertising, we think Amazon should come out on top because its business is less affected by Apple's changes to app tracking and transparency than Meta, Snap, and other digital advertisers. Amazon also has a lot of private information and real-time information about its users that it can use to sell ads. Amazon's most well-known business, e-commerce, benefits from network effects, which happen when many buyers and sellers bring in more buyers and sellers. More than half of the goods sold on Amazon.com are sold through Amazon's third-party marketplace. In exchange for fulfillment services, the company gets a sale cut. Also, Amazon Prime subscription fees are bringing a lot of money, and people tend to keep using the service because it's so good. Amazon's price has become reasonable after years of being out of our price range. The current EV to EBITDA NTM ratio is about 12x, while the average in the past was over 20x. Lastly, the company's balance sheet is great with a debt rating of AA, S&P rating, and no net debt net of cash. Number 2, Becton Dickinson, ticker symbol BDX. Becton Dickinson sells medical devices, hospital supplies, diagnostic equipment, and systems for keeping track of medications to hospitals and labs worldwide. Management thinks that at least one BDX product is used on 90% of patients who enter into acute care setting. In the past few years, Becton has dealt with several company-specific problems made worse by the pandemic. Still, the company was very important during the pandemic because it was the world's largest maker of syringes and needles and one of the largest providers of COVID-19 tests. Importantly, the management put the money from the COVID-19 windfall back into the business. Also, over the past couple of years, they have sold off some of their slower growing businesses and made several tuck-in purchases. These projects will improve the company's overall growth and margins as management works to return to its long-term growth formula: mid-single-digit organic growth, low double-digit EPS growth. At the moment, BDX shares trade at 20.7 times fiscal year 23 earnings per share projected, which is much higher than the S&P 500, but about the same as its medtech peers. The yield on the stock is 1.4%. Number 3, Johnson & Johnson, ticker symbol J&J. Johnson & Johnson is one of the world's largest and most diverse healthcare companies. Its revenues come from 3 different areas: pharmaceuticals, medtech, and consumer. The company should continue to do well because the world's population is getting older and the living standards in the world's emerging economies are improving. The pharmaceutical segment of J&J will likely be able to keep growing faster than the market over the next few years, thanks to its wide range of products and promising pipeline. We've seen a strong recovery in the medtech business after a few years of poor market performance. This is because the company's investments in its pipeline pipeline are starting to pay off. Surgical robots, tools for minimally invasive surgery, and new types of contact lenses are all recent examples of new products. J&J has a rare balance sheet with a AAA rating, makes a lot of free cash flow, and consistently makes above average returns on equity. These qualities back up the idea that the company is one of the safest stocks you can buy. Also, the stock trades at just 18x estimated CY 2023 EPS, which is only a small premium over the S&P 500. This reasonable multiple, the dividend yield of 2.5%, and our expectation that J&J will continue to grow faster and more steadily than the market over the next 5 years are why we like the stock at its current price. And don't forget, if this information moves a bit too fast for you, either play the video in 1x or 0.5x, or even watch it again. Number 4, Mondelez, ticker symbol MDLZ. Mondelez International is a big company that makes food and drinks. In 2012, it was split off from Kraft. The company operates in many different parts of the world, including Europe, North America, Latin America, Asia, the Middle East, Africa, and South America. Since CEO Dirk van de Put took over in 2017, he has implemented several strategic changes that have made MDLZ more competitive. These include, number 1, investments in its brands to increase market share. Number 2, a decentralized organizational structure that makes it easier to make decisions. And number 3, investments in the supply chain, which gave MDLZ an edge during the pandemic. Recently, the company has been able to counter the effects of inflation thanks to its pricing power and efforts to increase productivity. Also, there is little private label competition in sweet snacks and chocolate, which make up 80% of total sales. Consumers have become less likely to switch to cheaper brands as prices increase. The company has a strong balance sheet and steady cash flow, so it can pursue tuck-in mergers and acquisitions as the management looks to expand into higher growth adjacent categories like cakes and pastries, premium snacks, healthier snacks, etc. 21.9x CY23 earnings per share, cheaper than other multinational consumer packaged goods companies such as Pepsi, Coca-Cola, Procter & Gamble, and CL. Over the long term, we would expect MDLZ to have total returns in the double digits, which would be made up of EPS growth in the high single digits and the 2.3% dividend that it yields. And number 5, Microsoft, ticker symbol MSFT. Always a great choice, but in this particular year, Microsoft is one of the world's biggest tech companies. It has changed from a Windows PC first world to a cloud first world. Through its cloud, app, infrastructure, and AI offerings, the company has become a strategic partner in the digital transformation of large businesses. Cloud growth still has a long way to go as businesses dealt with old investments that provide value but must be moved to the cloud. MSFT is uniquely positioned to grow its corporate IT budget share in this hybrid world. It is also finding new opportunities in security, compliance, and workflow, and the change to subscription-based sales is no longer hurting free cash flow growth. Shares trade at 23 times the estimated earnings per share for CY23. The higher price is fair because the growth is above average, the company is exposed to long-term trends, and the balance sheet is strong. Also, when compared to other software, the price is quite fair. The yield on the stock is 1.1%. And thank you for watching this video on the top 5 best stocks to buy in 2023. There will be a follow-up video at the end of the year to see how we did in these. Remember, investing in the stock market always carries some level of risk, so it's important to do your own research and invest only what you can afford to lose. We hope you found this video helpful and that it gave you some ideas for stocks to consider for your own portfolio. As always, be sure to consult with an expert before making any investment decisions. Thanks for watching and happy investing.